Good morning, good morning, good morning. Today we're talking about Adobe. The stock just reported earnings. They announced a major acquisition and the stock is down 11%. This was pre-market. It's actually down 14% now that the market is open. Today we're going to talk about Adobe earnings and whether or not I think the stock is a buy or a sell at these levels. If you don't know me, I'm Austin. I'm building a $1 million portfolio right here transparently on YouTube, and I'm sharing every step of the way. Here is the current portfolio just to be transparent. $98,669. It looks like this morning we're up about 0.5%. Overall, this is since February 16th, 2022. We have put in $96,460 and we're at $99,063. So we are up about $2,600, which is showing up 4.88%. I have a big announcement. If you want to follow my portfolio and you want to get email alerts and SMS alerts anytime I make a trade, the best way, the fastest way to do that is Savvy Trader. I have put the link down in the description. You can subscribe to my portfolio to get buy alerts anytime I make a transaction, a buy or a sell. And full disclosure, I do charge $10 for that. If you like it, great. Sign up. If not, if you want to sign up but that's too expensive or something, just reach out to me. My email is right here on YouTube. You can find it, and I can help get you set up. So you can see right here position sizes. Snowflake is my largest, then Rocket Lab, Crowdstrike, Gitlab, Meta, Datadog, The Trade Desk, Tesla, Cloudflare, MongoDB, Bill, Shopify, which is a new addition, AirBnB, and then Melly. And then this is pretty cool. So this is since the start of my portfolio on Savvy Trader, which I started it on Savvy August 29th. So it's going to be different than what you see. This is not my actual portfolio performance. Over time, they'll be about the same, but for now, there will be a bit of a difference. But the cool thing is it compares it. You can compare it to the S&P 500, the Dow, and the Russell 2000. You can compare my performance to. So, anyways, really cool. And then you can also see. And this is just great for keeping people updated. You could go in and see every transaction that was executed. So transaction history, if it was a buy or sell, what I bought, how many shares, and the price. So anyways, just trying to improve this and offer more transparency and more coverage for those people that want it. All right, let's get into Adobe and whether or not I think today's drop is an overreaction. Okay, well, all right, so just quick update. This does actually track my portfolio a little bit over here. It looks like Datadog is running higher, Snowflake. So I would bet that the portfolio is actually up more than 0.5%. Let's see. So today, portfolio is actually now up 1.4%. So whatever, it's just a day, but hey, having a good day. So Adobe announced that they're acquiring collaborative design platform developer Figma for $20 billion, and they gave a mixed bag of business update. That's why the stock is down. So here's some of the details. It'll be half cash, half stock, and Figma Chief Executive Dylan Field and company employees would also receive 6 million additional Adobe restricted stock units that'll vest over 4 years following the closure of the deal. Okay, so that's the reaction here. It's on the earnings. They missed on guidance, they missed expectations on revenue, and they lowered guidance, or they missed on guidance for Q4. So there's that, plus this acquisition. So they're actually diluting the stock a little bit by giving additional shares, and then they're depleting cash a little bit. It's a $20 billion deal, so $10 billion in cash to make this purchase. Now, that doesn't mean this is a bad deal. We have to look at what the impact of this is going to be and how much cash they have on the balance sheet and all that stuff, which I'll get into. But that's the setup. Here's part of this big reaction, right? So Adobe expects Figma to add to the company's earnings by the third year after the deal's completion, which suggests Adobe earnings might be negatively impacted from the deal for 2 years. So the way this works is stocks have a PE ratio. Say the PE ratio is 10. If the earnings go higher, then that PE ratio goes lower. And so what tends to happen is if earnings go up, then the PE ratio will either stay the same or actually increase potentially because earnings are growing, right? And so that results in the stock price going higher. When you lose earnings, when earnings shrink, if the stock price stays the same, the PE ratio automatically goes higher because there's less earnings. And so what is happening really with this drop today is the market is adjusting to the changed guidance and changed expectations, and they're likely now adjusting to what the models are saying earnings will be reduced by over the next couple of years. That's why the stock price is going down today. I'm not saying that that's right or wrong or there's not a long-term opportunity here. Maybe there is. But that's how stock reactions work in the short term, the day of. I don't trade like that. I invest for the long term, but it's important to know the factors that are at play and why things react the way that they do. So when we look at it being down 14%, it's really probably like about even if we look at the reduced guidance plus the expected change in earnings that are going to happen due to this acquisition and the change in cash on the balance sheet. The stock price is probably the same. And so now investors have to decide, do they like Figma? Does having Figma put Adobe in a better position, create more competitive advantage, more of a moat, and provide more long-term earnings and revenue growth opportunity for Adobe than previous? And are they getting that at a good price, meaning it'll pay off in the long term? That's what investors have to decide right now. And so here's what I was talking about. They said for its fourth quarter, they expect earnings excluding one-time items of $3.50 a share on revenue of $4.52 billion, and analysts had expected earnings of $3.47 a share, so they did beat that a tiny bit on $4.6 billion in revenue, so they're going to miss on revenue. Okay, let's jump into this thread by Scott Belsky. He is the Chief Product Officer at Adobe. He's actually talking about some of their thoughts behind this acquisition. It's pretty cool. Twitter can be good for some things. There's a lot of trolling on Twitter, but it can be good for some things. I love how he didn't even use autocorrect, and he probably just typed this out on his phone because you could see lowercase I. He deeply admires Figma's. He also didn't capitalize Figma, which I'm not sure if it's supposed to be or not. But anyways, it's awesome that this is just it seems like it's coming off of the top of his head. I'm sure he thought it out. Anyways, Scott, if you ever watch this, not that you will, would love to interview you either on YouTube or through email or whatever. Have your people reach my people, and by that I mean me, because I don't have people. Would love to do it. Big fan. Anyways, Figma's approach to building a web-based platform for product and design and ideation and the community of designers and developers they've engaged. I think it's early innings for how ideation, design, code can come together and empower all stakeholders. Okay, so that's kind of their thought. Okay, and here's kind of how he's thinking about big picture about the future. Our teams have much more to learn from one another and a rare opportunity to imagine a bolder future for product design and beyond. Working together, we can advance the world of product design and reimagine other creative disciplines on an awesome extensible web platform. This is how it's going to work kind of operationally. Figma will operate with autonomy, continuing to work their magic. No plans to change prices, and will also continue to be free for education. We're eager to preserve what's great and tackle some of the new possibilities together. Okay, I think that's a good move. If they came in and changed the model immediately or didn't give them that autonomy, they're essentially taking everything away of what made Figma successful so far as an independent company. And they're still likely taking some of that away. I mean, that's just the nature of joining a massive public company for private companies. But they're at least preserving a lot of it. And so here's a little bit of history of a successful acquisition, right? So remembering the deluge of doubts in 2012 when we shared Behance's acquisition, 10 years later, platform grew 30x. Product stronger than ever, brand intact, still free, high growth, and continued pipeline of goodness. But it takes work and principles, like all bold moves show over time. I love that he's saying that. So now let's get down to is the stock, in my opinion, a buy, a hold, or a sell right now? I do not own shares right now, but I have certainly thought about it. I mean, the first thing I want to see when I'm thinking about owning a stock, it's gotta be a real company, and I would prefer that it's a long-term market beater. Well, right now we're looking at 20 years of history. Adobe has compounded at 16% per year versus the S&P 500 of 8%. That turns an initial $10,000 investment into $242,000 over those 20 years. S&P 500, still a nice return, $10,000 turned into $59,000, but still life-changing money versus, pay for your kid's college or something like that, which would still be awesome. Hey, just looking at the last 10 years, and it's actually been even better. Adobe's up 27% per year over those last 10 years versus the S&P 500 up 13% per year. So S&P 500 has done really well, but Adobe has done basically double the S&P 500. Now let's think about the stock price, right? Just according to the PE multiple, which is a decent way to look at stocks, but it doesn't tell us everything, right? What we can see here is that over this time period, this is since 2011, This blue line is the average price to earnings ratio that Adobe has traded at during that time. It's been 39.4. This line right here represents the current share price, and we can see the current PE is at 27.9, so about 28, which is obviously lower than its average PE. So you would think it's a great buying opportunity, but we have to consider more than that. Over that time, Adobe has had 17% earnings growth per year. So let's remember that 17% earnings growth, 39 PE. Okay, now we've come to estimates. We have analyst expectations for earnings per share, and this is before the this announcement, right? So these are going to change, but let's just go with this. They're expecting 8% growth in 2022, 17% in 23, and 15%, 16% in 24. The problem is that over the next 3 years, these are actually going to be less than this, and in fact, potentially, I mean, they're not going to have negative earnings, but they'll have potentially negative earnings growth. It just depends on how much, how unprofitable Figma is and how much that's going to hurt their earnings. These numbers are definitely wrong, but it's a frame of reference, right? And so then I forecasted out, I think over time it'll normalize and come back up. I forecasted out 15%, 13%, and 13% growth. And so what we have is earnings growing from essentially $12.48 a share in 2021 to $26.90 a share in 2027. Okay, and then we can see what the stock returns would look like. If it stays at a PE of 28 through that time, then you're going to get about 14.5% annualized rate of return, or 102% total return through 11/30/2027. But the question is if a company is growing earnings at 12 or 13%, does it deserve to trade at a PE of 20? So let's just say we think that's a little bit high, and I think probability-wise, I think that it is most likely that at that time it would trade at a lower PE than 28. Investing is about dealing with improbabilities, right? Not absolutes. I have no idea what's actually going to happen, but I just know that as numbers get larger, as growth slows, PE multiples tend to come down. The kicker here is this Figma acquisition. If it works out way better than expected, these numbers might all be low. If it works out as expected or worse than expected, then these numbers might be too high and the stock price could be lower. This is all probabilities, right? But I think I'm most comfortable with a PE in 2027 based on, somewhere around these growth expectations of more in the 19 to 20, 22 line, right? Just based on the history of the stock, their business model, and how multiples generally work. So I think a realistic range to think about for performance over time is that in 2027, this thing would trade around a PE of 22 or, around that, for a total return of 63%, and that's almost 10% per year. Now that's still market beating on average, that outperforms the market, right? But I think there's a potential that it trades lower than that, right? So, let's reduce that by about 20%. And so I think that Adobe is going to trade in a range of around $484 a share in 2027, which would be a 30% gain, so 5% per year. So that's kind of like the low end range, right? This is a great business, and they're probably going to get better because of this acquisition. To an absolute high of somewhere around 752, which I think is on the high end, which would be 102% return for 14.5% annualized. I think most realistically it lands somewhere in the middle, and you get around a 6 or 7% to 10% annualized return. So Adobe could be great for an investor that likes kind of a more stable company, a proven company, high gross margins, recurring revenue. Could be a great option for somebody like that. I currently am not interested in buying it because I think there's a lot more opportunity and longer term opportunity in the companies that I own in my portfolio. And that's everything from Snowflake, Rocket Lab, again, Crowdstrike, Gitlab, Meta, Datadog, The Trade Desk, Tesla, Cloudflare. These have sold off so much, and they're smaller companies than Adobe, and I believe great businesses that I just think have longer growth runways ahead. I could be totally wrong, and let me know in the comments. What do you think? Am I right or wrong that right now these are better opportunities than Adobe, and it's just not a buy for my style of investing? Let me know in the comments if you think I'm right or wrong.